Welcome to Market Brief After Hours. Today's session was heavily dictated by escalating tensions in the Middle East and a renewed surge in oil prices. We saw a definite shift in investor sentiment, pushing the Dow sharply lower as markets tried to price in the economic fallout of the ongoing U.S.-Israel conflict with Iran. Add to that fresh inflation data, and we have a lot of ground to cover today.
It was definitely a heavy news day. The geopolitical risks are taking center stage right now, completely overshadowing some of the more stable economic data we've been seeing. When energy prices spike with this much momentum, it sends ripples through everything, from equities to the bond market and certainly into the currency markets.
Let's break down the major U.S. indices first. The Dow Jones Industrial Average took the biggest hit, falling 0.61% to close at 47,417. The S&P 500 had a really choppy, volatile session, eventually edging lower by 0.08% to finish at 6,776. But the Nasdaq actually managed to eke out a tiny gain, rising 0.08% to close at 22,716.
The divergence there is a fascinating storyline. The Dow felt the full brunt of the energy and geopolitical fears, largely because of its industrial components. But the Nasdaq was kept afloat almost single-handedly by a massive rally in Oracle. Their shares jumped about 9% after reporting incredibly strong fiscal third-quarter earnings. In times of broad market panic, a massive earnings beat from a major tech player can absolutely anchor an entire index.
Speaking of market panic, let's talk about the inflation data that investors were digesting today. The U.S. Consumer Price Index rose 0.3% in February. That matched economists' expectations and follows a 0.2% increase in January. Year over year, inflation is holding at 2.4%.
Which is still stubbornly above the Federal Reserve's 2% target. What's crucial to understand here is the underlying driver of this month's data: gasoline. Gas prices have jumped more than 18% to $3.54 a gallon since the conflict in the Middle East escalated in late February. If supply disruptions in the Persian Gulf continue, those elevated energy costs are going to bleed into the broader inflation outlook for months to come.
And we saw oil markets react aggressively today, despite major interventions. West Texas Intermediate futures climbed more than 4% to settle at $87.25 a barrel, while Brent crude gained about 4.8% to close at $91.98. This happened even after the International Energy Agency announced a massive, historic release of emergency reserves.
They've agreed to release 400 million barrels from strategic reserves. It's the largest coordinated release in the IEA's entire history, aimed squarely at stabilizing the market. But the fact that oil surged 4% anyway tells you exactly how much fear is priced into the market right now. Traders are looking right past the temporary release of the reserve release and focusing entirely on the potential for long-term supply shocks.
Naturally, Treasury yields moved higher as investors processed all this. The benchmark 10-year yield climbed more than 8 basis points to 4.222%. The 30-year bond yield crossed above 4.87%, and the 2-year advanced to 3.644%.
The bond market is essentially signaling that the Fed might have to keep rates higher for longer. Persistent inflation pressures, combined with a sudden spike in global energy costs, make it very difficult for the central bank to justify any near-term rate cuts.
That cautious sentiment certainly wasn't limited to the U.S. European equities took a beating across the board as traders monitored the intensifying military activity. The Pan-European Stock 600 dropped 0.8%.
The regional breakdown in Europe paints a pretty bleak picture. Germany's DAX was the hardest hit among major markets, falling 1.62%. Italy's FTSE MIB lost 0.95%. The UK's FTSE 100 dropped 0.89%. France's CAC 40 slipped 0.54%, and Switzerland's SMI declined 0.82%.
We also got some mixed economic signals out of Germany today. Annual inflation eased to 1.9% in February, down from 2.1% in January, though core inflation held steady at 2.5%. But German exports fell 2.3% month-on-month in January.
That export drop is a major red flag for Europe's largest economy. It highlights weakening economic momentum right at the exact moment geopolitical instability is peaking.
Over in Asia, the markets delivered a really mixed bag. South Korea's Kospi was the absolute standout, surging more than 5% to 5,532.59.
That was driven by some incredible export data out of South Korea,
a 55.6% year-on-year increase in the first 10 days of March, heavily fueled by semiconductor sales. It shows that the AI and tech boom is still a massive economic driver globally. Japan also had a solid day, with the Nikkei 225 rising 1.43% and the Topix advancing 0.94%.
Hong Kong's Hang Seng climbed 2.17%, China's CSI 300 gained 1.28%, and down in Oceania, Australia's ASX 200 rose more than 1%, while New Zealand's NZX 50 jumped 1.52%. But India didn't fare as well today.
No, Indian markets were quite vulnerable to the oil news. The Sensex fell 1.7% and the Nifty 50 dropped 1.6%. India is a massive importer of oil, so rising energy costs immediately spark concerns about domestic inflation and slowing economic growth there.
We are going to take a quick break, but when we come back, we'll dive deep into today's Forex movements, including some critical moving averages, and we'll look at the individual stocks making massive moves today, including a massive buyout in the food sector. Stay with us. Welcome back to Market Brief After Hours. Let's pivot to the foreign exchange markets, which saw some fascinating technical setups today. Starting with the euro against the dollar, Euro USD finished the session at 1.1576, falling 0.3%. It traded between a high of 1.1646 and a low of 1.1561.
The technical structure here is looking very bearish. The 50-day simple moving average is at 1.1755, the 100-day is at 1.1694, and the 200-day is at 1.1672. Because all those key moving averages are positioned above the current price, it reinforces a clearly bearish trend. The pair has established a sequence of lower highs and lower lows after failing to hold above the 1.1700 level. Immediate resistance is at today's high, while support sits at the session low.
Looking at the British pound, GBP USD closed slightly higher at 1.3421, gaining just 0.03%. It bounced between 1.3458 and 1.3394.
Buyers actually stepped in right near the 100-day moving average, which is at 1.3398. But the broader picture is still really mixed. The price is trading below the 50-day moving average of 1.3528 and just under the 200-day moving average at 1.3444. This setup suggests we are in a period of consolidation within a wider range, roughly between recent highs near 1.3800 and lows around 1.3200.
The Australian dollar had a stronger showing. AUD-USD closed at 0.7156, rising 0.51%.
The uptrend there is firmly intact. It's trading comfortably above its key moving averages. The 50-day is at 0.6940, the 100-day at 0.6753, and the 200-day is way down at 0.6643. That's a textbook bullish structure across multiple timeframes, showing a consistent pattern of higher highs and higher lows since late last year. Immediate resistance is the psychological 0.7200 level.
Finally, USD JPY climbed to fresh highs, closing at 158.92, up 0.56%.
The bullish momentum here is incredibly persistent. The pair is supported well above the 50-day average at 156.2, the 100-day at 155.63, and the 200-day at 151.48. It's just a steady climb of higher highs. Immediate resistance is right at the 159.00 psychological level.
We should also touch on the precious metals. Gold slipped 0.18% to close at $5,182 after trading between $5,223 and $5,149.
Even with the slight pullback, gold's uptrend is incredibly strong. It's holding comfortably above the 50-day moving average of $4,897, the 100-day at $4,535, and the 200-day at $4,013. It's basically consolidating before it potentially tests that recent peak near $5,400.
Silver had a much sharper drop, falling 2.65% to close at $86.04. Let's wrap up with today's big market movers, starting with a massive surge in the restaurant sector. Papa John's shares skyrocketed 19% today.
This was driven by reports of a $1.5 billion private equity takeover bid from Earth Capital Management.
They are offering $47 per share, which is a massive 50% premium over the stock's previous closing price. A premium that large instantly resets the valuation and explains the massive pop in the share price today.
In the tech space, Nebius Group climbed 16%.
This is a major artificial intelligence cloud company, and today Nvidia announced a $2 billion investment in them. The goal is to expand AI infrastructure capacity, allowing Nebius to deploy more than 5 gigawatts of capacity by 2030. Whenever Nvidia throws its weight and capital behind a company right now, the market pays very close attention.
On the downside, Cadre Holdings plunged more than 13%.
A classic earnings miss. The safety equipment manufacturer reported quarterly earnings of 27 cents per share, which completely missed the 40-cent estimate. Revenue also came in light at $167.2 million versus forecasts of $182.9 million.
And Campbell's shares dropped nearly 7%.
They lowered their full-year earnings guidance. Management cited weaker demand and rising cost pressures. In an environment where inflation is still sticky and energy costs are rising, companies that admit they are struggling with cost pressures are going to get punished by investors.
That brings us full circle to where we started. Heightened geopolitical tensions and surging energy prices are dominating market sentiment right now. While inflation broadly matched expectations this month, the sharp volatility in oil markets and risks to global supply routes are creating a lot of uncertainty for corporate earnings and growth in the months ahead.
Exactly. Investors are going to be watching the trajectory of energy prices and the headlines out of the Middle East very closely. Those geopolitical developments will likely remain the primary driver of global financial markets in the near term.
Thank you for joining us for today's breakdown. If you find this useful, please follow Market Brief after hours.